Make Better Wealth Decisions, a podcast that explores how financial advisors' blind spots can harm your investments. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto. In this podcast, we'll provide advice on how you can achieve better outcomes by maximizing investments and minimizing taxes. Let's put our thinking caps on as we consciously decide to get smarter about our money. Welcome back to the second half of our interview with Jeff Rubin. Once again, for those of you who are unfamiliar with the man, because most of you know who he is, he's a bit of a superstar in Canadian economic circles. He is an economist and an author. He's the former chief economist at CIBC World Markets, and he's a senior fellow at the Center for International Governance and Innovation. His latest book, A Map of the New Normal, has been out since May, and we're talking about it this week. Jeff, welcome back.
Good to be back again.
We spoke a lot about how people were coming to terms with this new normal of inflation being systemic and baked in as a result of sanctions and the way the world had changed geopolitically. And I'd like to begin this podcast by asking you to maybe just offer your thoughts on the extent to which you believe people have come to recognize this new normal. Is it the sort of thing that you find is a novel thing when you talk about it with people? Or do people intuitively understand it and recognize it and say that, yeah, they're changing their expectations as a result of the way they've interpreted events of the past 2 or 3 years?
Well, the people who have quickly understood what this means and they don't need any guidance from me are unions. Okay. Unions have immediately realized the world has changed and they got a lot of catching up to do. So they definitely have changed. In terms of the general population, I think that we're still in the early stages because you got to realize something, John. Everything that we're saying here is totally at variance to what you would hear in the financial press and better than
Yeah.
I, and not just the financial press, the mainstream media. Okay. Everything about how great the war is going in Ukraine and Russia's about to crumble and China's about to crumble, and there's no relationship between that and grocery prices and oil prices. It's just one big coincidence. We've been raised on believing in globalization for 40 years. This is not going to change in an instant. And all of our policymakers, from the Federal Reserve Board to the Bank of Canada, don't worry, everything is on cruise control. We're heading back to 2% inflation. The supply shocks are behind us and nothing has changed. So, in that context, it's perhaps not surprising, but expectations are, if anything, adapt.
Huh?
And we're going to adapt. We're going to adapt to this new normal and we're going to recognize that it's not a black swan event, nor is it a cyclical blip. This is a secular, long-term change in how our economies operate, and everyone's going to have to reposition how I can fit in because we're going from a world where economies specialized in a narrow range of things, the model of comparative advantage, to a model of jack of all trades. Okay. When was the last time we made a toaster? 40 years ago. Well, let's start making toasters because we don't want to import any from China. It'll support their military. Okay. So, that's a quantum change, but we're going to see when we buy a toaster, why the hell did this coaster cost 8 times as much as the last one I bought? Guess what? It wasn't made in the same place. It wasn't made by the same workers. They don't get paid the same as workers in China. So, over time, we'll adapt.
So I've been saying much the same thing, and I call it bullshift, how the financial services industry shifts your attention to make you feel bullish. So don't worry about what you're reading in the headlines. That's over there, that's overseas, and that doesn't have any impact on you, Mr. Jones or Mrs. Smith. But in
Right.
fact, it absolutely does. But nobody wants to connect those dots. It's especially difficult for anyone who's in power politically, because if you're the incumbent, you have to be the bearer of bad news, even if there's no direct culpability. It's not necessarily anything that you've done. These are things that would have happened anyway. Now, you spoke a moment ago about expectations, and I wonder if we can then take this one step further. We're about a little over 3 months away from an election south of the border. And it looks as though we finally have some certitude about who the candidates will be for the presidency.
Uh-huh.
You mentioned expectations. What would you expect? Nobody knows. I'm not asking a major prognostication, but just in very broad brushstrokes, what would you expect to be the geopolitical and as a result, the economic and inflationary ramifications of both a Trump win and a Harris win? And not just the presidency, but also the House and Congress. If you could just give us
Okay.
your very brief thoughts. I don't need to go very deep.
Okay. First of all, I don't see this in terms of individual. Trump, Harris, Putin, Xi. I think you get head fake when you start focusing on individual. I see this in terms of colliding geopolitical plates, okay? Of other countries saying, you know what, the United States, you've been the global hegemon for 100 years. Time to move over. Okay. And it's not really going to matter who the leaders are of those other countries or who the leaders are in the United States. Let's take the United States. You remember when Trump first imposed the tariff? Biden and all the Democrats denounced this as, oh, this is insane. This will only hurt American consumers. What did Biden do when he got in power? Was one tariff ever rescinded? No, he doubled down. So I don't think it's really going to matter whether it's Donald Trump or Kamala Harris. They are going to impose new tariffs on China, and China will retaliate. And we're not talking about sanctioning Russia. Russia is America's 30th largest trading partner by volume of two-way trade. Yeah, they're important in energy and food, but they're almost non existent in manufacturing exports. China, on the other hand, is America's number one trading partner by two-way trade. When you start slapping on tariffs on them, guess what? It's going to show up in the US CPI. So in that case, it's not going to matter. On Ukraine's side, yes, and not just Ukraine, because whole NATO say this is more than Ukraine. This could be whole NATO is at stake. Donald Trump believes that Eastern Europe is Russia's sphere of influence. Just like, Central America, South America, North America, the Monroe Doctrine is America's sphere of influence. Okay. And I think that Trump has no appetite to extend military support to Ukraine. And for that matter, may well question what America's interests are in NATO. So there, I think a Harris versus Trump victory would have a tactical impact. Okay. But as I said in my earlier comments, the war in Ukraine could be over ostensibly in 4 to 5 months, depending on the outcome of the election. Sanctions are here to stay. In other words, the sort of proxy war that America is fighting against Russia using Ukrainians as fodder, that may be over, but the economic war is here to stay.
My wife was born in Kharkiv, Ukraine, and so I've had a bit of a front row seat from my home of this war since before it started because she listens to podcasts literally for over an hour a day, pretty much every day, and gives me frontline reports from people that are on the inside that you don't usually get from North American media. So I feel that I've been fairly well versed in this, and I've learned a lot of things about geopolitics and in history that I really hadn't thought of before. Once again, I have another question for you about how you think people think about knock on effects. So let's say we now have Donald Trump saying that he wants to see NATO countries spend 2% of their GDP on their defense obligations. And Canada, forever, for the past 35 or 40 years, has failed to do that. And what I'm wondering about what your thoughts would be, have Canadian investors thought about what that would mean for government debt levels, for instance? Because if governments do, in fact, start to meet those obligations because they have to fill the vacuum that's being left by US exiting that space and being the de facto protector of central parts of Europe that are either in NATO or close to NATO, do you think people have really realized that this is going to be tens of billions of dollars that is going to have to be diverted from the national expenditure to either A, meet those obligations and therefore take that money out of social programs, or B, don't take that out of social programs, just run up the national deficit and debt. Do you think Canadian investors have come to that realization?
Before answering that, for NATO to live up to its 2%, which they probably never will, ask yourself this. Do they still have the industrial capacity to actually produce the armaments that the 2% target would have? Because guess what? Their industrial sectors have been hollowed out for the last 30 years. Russia, on the other hand, has their economy on a war footing. It's like going back to Stalin's 5-year plans. Heavy industry is soaring. So, are we going to import these munitions from Russia or from China? Because right now, NATO does not have the industrial infrastructure to produce armaments of the kind that are being suggested by this 2% ramp up in spending. Now, let's just ignore that question and just assume that they do. Okay. Is there an appetite, particularly in Canada? Because don't forget, Canada's not on the front line. Okay. Russia's not coming over the North Pole. Okay. So it's a little bit different than Latvia, Lithuania, Poland. Does Canada, that faces no real military threat from Russia or China, want to all of a sudden take billions out of social spending and health into armament? I would say no. So if they're going to do that, it would be an increase in the deficit. Does that matter? I guess it depends on who's buying the bonds. If it's me and you, it's going to matter because we're going to be wanting to be paid a higher yield the bigger the borrowing program. If it's the Bank of Canada, they can just flick the switch and let the printing presses run. Did it once, they can do it again.
And they've done it many times. So people like Ray Dalio, who I don't know if you know who Ray Dalio is. He's a hedge fund manager at a firm called Bridgewater and one of the world's leading geopolitical commentators. And he's written a book about the changing world order. Again, very similar. His thoughts are very similar to yours. And Dalio's book came out maybe 3 years ago, and he talks about these cycles, how empires, and he uses the British Empire and the Dutch Empire and the American Empire as examples, ebb and flow, and how there's a certain cyclicality and there's a certain sequence of things that happen. And one of the things that is usually the harbinger of the end is when the military power is lost, the economic power is
That was
lost,
a lot.
and the de facto reserve currency status
That's
is
a very good
lost.
point that you raised, John, because in the 19th century, the reserve currency was the British pound because Britain was the major exporter of capital. In the 20th century, the reserve currency, at least ever since Bretton Woods, after the conclusion of World War II, was the dollar because America was the capital exporter of the world. Guess who the largest capital exporter of the world today is by a country mile? China. What does that suggest about the ability of the dollar to remain the reserve currency? They've already lost the petrodollar currency. I mean, up until just a couple of years ago, from 1974 on, every barrel of oil sold by OPEC was in dollars that was in turn reinvested in the US Treasuries market. That all came to an end by the brilliant move of the Janet Yellen when they said that we're not going to allow Russia to use dollars for their oil and gas. And Putin went, fine, we'll charge rubles. And all of a sudden, lo and behold, the largest energy exporter in the world wasn't accepting dollars, it was accepting rubles. And shortly thereafter, China, the largest world's importer, decided that it would pay Saudi Arabia, its major supplier, not dollars, but yuan. So when the world's largest energy exporter no longer uses dollars, and when the world's largest energy importer no longer uses dollars, then I'd say the era of the petrodollar is over. And the next shoe to drop will be the US dollar will stop being the sole reserve currency of the world.
And that even by itself will have destabilizing and massive repercussions that a lot of people, again, I'm going to keep on repeating this, a lot of people that shoe hasn't dropped. Most people haven't
No,
come to
it
that
hasn't.
realization.
And it's going to raise the cost of capital because the biggest funder, ironically, of the US Treasury, foreign funder, was the People's Bank of China. Do you think they did that as an act of benevolence to US taxpayers? They did it because they wanted to hold the yuan down against the dollar. And obviously, the more dollars they bought with yuan, the lower the yuan dollar exchange rate. Well, they did that because the US was their largest trading partner. But if sanctions and tariffs are going to change that, then why does the People's Bank of China have to continue to hold dollars? They're not. They're selling them. The sales have been the most massive in 20 years, and other BRIC central banks are doing the same. So, what President Biden didn't realize when he so eagerly confiscated the $300 billion of dollar reserves held by the Russian central bank was he was knocking down one of the fundamental pillars that made the dollar the reserve currency. Because central banks would hold dollars in their reserves as an insurance policy against financial risk. Instead of an insurance policy, it became a ticking time bomb because at any moment in time, some administration in Washington could decide to confiscate those dollars. And there's no way a central bank could hedge that risk other than not holding dollars, which is
Right.
exactly what's going to happen.
So, on that happy note, let's move to something even more deliriously happy. I want to talk to you a little bit about the environment. You've got a full chapter in the book about the environment, and there's some finger pointing as to who's mostly responsible for the sabotage of the Nord Stream pipeline, but you've got a pretty good idea of who it really
I think
is.
most people at this point got the idea.
But the knockoff effects, again, this is what a lot of people don't think of. The first derivatives of
Uh,
changing your trading partners and then having to substitute cheap Russian energy for more expensive North American
right.
energy. But oftentimes, because of the difficulty in substituting, you're not only getting more expensive energy, you're getting dirtier energy.
Absolutely.
What help maybe help the people that are
Okay.
tuning in here
I,
just to
I was
understand what
just
that means for the Paris Climate Accord of 2015 and going beyond.
I was just having a conversation about this with David Suzuki. I was out in Vancouver on a book tour and telling him this is the biggest setback next to energy prices themselves. I would say that global efforts to reduce carbon emissions is the biggest casualty of sanctions. Now, when they were first unveiled, they came in coats and coats of greenwash. Like all the policy circles in Europe were saying, well, this will accelerate the move away from hydrocarbons because Russia is our major supplier of oil, coal, and gas. But it wasn't windmills and it wasn't solar power that replaced Russian oil, coal, and gas. It was coal and American LNG. And the irony has been that even though Germany, which is world leader of preaching to the rest of the world on how to do it, even Germany is seeing a renaissance in coal demand. There are three closures were canceled. 10 mothball plants have now been restored. And it was done coincidentally with the shuttering of the last three nuclear power plants.
Yeah.
Somehow in German ecology, it's okay to shut down nuclear plants and replace them with coal plants. In England, for the first time in 20 years, a new coal mine is being commissioned because they expect huge demand from coal-fired thermal power. Now, here's the challenge going forward. President Biden has sacrificed a lot of his environmental objectives. Solar power, forget it, because all the batteries were made from China, okay? Our future administration's gonna make the same trade-offs as the evidence of climate change becomes starker and more compelling. Because the problem is that if we think our enemies have too much clout on hydrocarbon, wait till you see the clout they have on things like batteries or rare earth elements or lithium or any of the strategic metals. Because if we do go full face towards that transition, it's the BRICS countries, not the G7 NATO countries, that are holding the cart.
So then to conclude, in terms of putting a nice little bow on all of this, I want to talk about the new Cold War and the risk of it becoming a hot war, because I think by now people have come to realize that there's a de facto alliance between China and Russia, and that there are other surrogates like Iran that are happy to help out when they can. We've just had a situation where China and Russia just flew some planes over the border of Alaska very recently, just to see what kind of a reaction they would get. And apparently, NATO flew some planes that have nuclear capacity over the Baltic nations, not far from the Russian border, just to respond. So that we're getting some saber rattling. And I would argue that the Cold War has gotten hotter now in 2024 than it has been at any time since, let's say, the Bay of Pigs over 60 years. And there's a real risk. And I don't, again, what I wonder is in the 80s, when Reagan was having his SALT talks and people were talking about finding ways to decommission nuclear arsenals, that was top of the mind. It was in the front of the paper every day for months at a time. Now we're actually in a situation where things are perhaps riskier and it's not getting much by way of headlines. So once again, I ask, do you think people are aware of the risks that we're facing right now from a military perspective?
All I can say on that is our enemies are going to get a lot stronger. Let's compare China and the US. The US spends on defense more than the entire GDP of Africa. The US spends on defense more than the next 9 leading defense spending countries put together. China and the US economy is almost equal. On purchasing power parity basis, they are. Even in US dollar terms, within 5 years, China will be as large, if not larger. Yet China's defense expenditures are only 25% of America's defense expenditures. Who do you think is going to be better able to ramp up defense spending in the future? And the same is not just China, the same is with BRICS. And this isn't just Russia and China. India, South Africa, the whole global south. There's a lineup around the block for countries to join BRICS, including Mexico, which wants to hedge its trade agreement with Canada and the United States. So, yes, it's going to get hotter, and our enemies are definitely in a better position to ramp up defense spending than anybody in NATO, including the United States.
So, again, for the people that are listening at home, the book is called A Map of the New World Order. Sorry, The Map of the New Normal. And I want to thank you for your time today, Jeff. And before I let you go, I want to ask you one last thing. I call this decision time. If it was up to you, what one thing would you give as a piece of advice to the people listening today to help them make better financial decisions for their own portfolios and for their own lives?
Well, financial advice, I guess, should be left to the professionals such as yourself, John. I'm just an economist and a writer, but let me point out one thing that may be pertinent to investment decisions. If there's one takeaway from this very enjoyable discussion that I'm having with you, it's inflation is back to stay. And so are today's interest rates, if not higher. That, I think, should be the bedrock foundational premise of everything that you do insofar as your financial planning and your business planning is concerned.
Jeff, I want to thank you so much for your time today. I know you're a busy man. It's been a real pleasure on my end as well.
It's good catching up with you. It's been a while.
John DeGuy is a portfolio manager with Design Securities in Toronto. The views expressed in this program are not to be construed as specific advice. It is recommended that you consult a qualified advisor before taking action. His books, The Professional Financial Advisor 4, Stand Up to the Financial Services Industry, and Bullshift are available through Amazon and in bookstores throughout Canada. You can reach John at 647-STAND-UP. That's 647-782-6387 or at jdeguy@designedsecurities.ca.